Imagine for a moment that you're behind the wheel of a really high-performance vehicle.
Okay, I'm picturing it.
Right. And you glance down at the dashboard, and the diagnostics are they're an absolute nightmare.
Like warning lights everywhere.
Exactly. The engine temperature is deep in the red. The oil pressure light is flashing. You can literally feel the transmission starting to slip.
Oh, that's not good.
No, it's terrible. By every mechanical metric, the car is in a state of critical distress. And here's the crazy part. You look up at the speedometer, and you are smoothly, like almost effortlessly, accelerating past 120 miles an hour.
That is a terrifying scenario.
Right. That cognitive dissonance, that violent contradiction between terrifying internal diagnostics and this relentless forward momentum.
Yeah.
That is exactly what Wall Street looks like this morning.
I mean, it's a brilliant way to conceptualize the tape today. Because for you, the sophisticated investor managing capital in this environment, relying on traditional diagnostic tools, is just, well, it's a recipe for whiplash right now.
Yeah, totally.
The macroeconomic indicators are screaming systemic risk, while the equities tape is behaving as if we've, already entered this friction-free, high-growth utopia.
It's wild. But welcome to the deep dive. Today is Wednesday, March 25, 2026.
Let's get into it.
Yeah, we've got our hands on a really comprehensive, honestly incredibly dense Reuters market report that captures all of today's trading dynamics. And our mission for this deep dive is to help you map out the architecture of this deeply bifurcated market.
Bifurcated is the perfect word for it.
Yeah, we're going to deconstruct today's tape through two specific, violently opposing axes. On one hand, you have major existential macroeconomic risks that are threatening to derail global growth.
Right.
But on the other hand, we have these unprecedented capitalization-heavy opportunities linked to new technologies. And they are completely defying that macroeconomic gravity.
And the defining characteristic of today's session is that these two forces aren't just, passively existing side by side.
No, they're fighting.
Exactly. They're actively battling for dominance over the indices. It's this massive tug of war between the physical realities of geopolitics and the forward-looking projections of technological scale.
So let's set the baseline and look at the scoreboard, because the surface level numbers are undeniably aggressively green today.
Very green.
The Dow Jones Industrial Average is up 1.23%. That's adding over 565 points to cross the 46,689 threshold.
Huge move.
Yeah. And the S&P 500 is up 1.16%, slicing right through 6,632. And the tech-heavy NASDAQ composite is it's the vanguard of the entire rally today.
Leading the charge.
Up 1.47%, surging past 22,081.
If you are simply passively indexing, or say you only check your portfolio's top-line balance at the end of the day.
Which a lot of people do.
Right. You see those numbers and you just assume the global economy is operating in perfect frictionless harmony. I mean, in nearly 1.5% gain on the NASDAQ. That is a massive expansion of market capitalization in a single session.
Okay, let's unpack this. Because before we can even begin to dissect the multi-billion-dollar tech rallies we're seeing today, with giants like ARM and SpaceX, we have to acknowledge the geopolitical fault line that these green numbers are precariously resting on.
Precarious is right.
The foundation of today's broad rally is not rooted in some sudden, structural improvement in global GDP.
Not at all.
It is entirely rooted in a highly fragile, rumor-driven sigh of relief regarding the Middle East.
Precisely. And understanding the actual mechanics of that relief is crucial here. According to the Reuters data, the primary catalyst driving the broader market today is simply the hope of de-escalation in the Gulf.
Just the hope.
Just the hope. We have reports of a specific, highly complex back channel being utilized. The U.S. has reportedly transmitted proposed terms to Iran via Pakistan.
Wow.
Yeah, and furthermore, a high-ranking Iranian official leaked that either Pakistan or Turkey could potentially serve as the physical host for diplomatic talks.
Now, I look at this through the lens of market mechanics. When this headline hit the terminals, we saw an immediate, visceral reaction in the commodities market.
We certainly did.
Brent crude dropped nearly 4%, and not because a peace treaty was signed, not because a ceasefire was implemented, simply because an algorithm scraped a headline containing the words back channel and Turkey.
That's all it takes.
A 4% drop in global oil benchmarks on a whisper of proxy negotiations feels incredibly premature to me.
What's fascinating here is how quantitative models, and frankly human traders, are forced to price in geopolitical diplomacy when the underlying asset is as critical as oil.
Yeah, you can't ignore it.
You have to remember the geography here. The Gulf conflict directly threatens the Strait of Hormuz. We are talking about the narrowest, most critical choke point in the global energy supply chain.
The absolute bottleneck.
Exactly. Around 20 to 30% of the world's daily oil consumption transits through that specific corridor.
And when that corridor is threatened, the ripple effects are, they're immediate and measurable. It's not just some theoretical supply constraint.
Right. And it hits the balance sheets immediately.
Lloyd's of London, the major maritime insurers, they immediately jack up the war risk premiums for any vessel entering the Persian Gulf. Freight rates just skyrocket.
Exactly. The cost of moving a barrel of oil mathematically increases before a single drop of supply is actually disrupted.
Wow.
So that war premium has been heavily baked into the price of crude for weeks now. So when the Reuters headline slashes that a Pakistan-backed channel is open, the algorithmic logic dictates an immediate recalculation of probability.
They adjust the risk.
Yes. The likelihood of a total blockade of the strait drops from, say, 40% to 25%. Yeah. The models automatically dump oil futures, resulting in that 4% slide. The market is exhaling. It's releasing that pent-up premium.
I understand the algorithmic reflex, I do, but let me introduce some aggressive skepticism here.
Please do.
Because relying on that 4% drop as a signal of macroeconomic health seems incredibly dangerous. And the Reuters report actually highlights this exact tension. They quote Alex Spencer, the chief investment officer at Bogart Wealth.
Right, I saw that.
He asks, is this really credible thought or just headline noise? Because let's look at the actual reality on the ground here. Tehran has publicly, definitively stated on the record that they will not negotiate with the Trump administration, period.
And this is where we really have to separate domestic political theater from geopolitical game theory.
Okay, break that down.
Well, Alex Spencer is absolutely right to be skeptical. But you cannot take a public denial from Tehran at face value in this specific context. A public refusal to negotiate is a required mechanism for their domestic political consumption.
So it's for the folks back home.
Exactly. They cannot project weakness or capitulation to their internal hardliners or to their regional proxy networks. However, international diplomacy operates in the shadows.
Right. So the fact that a senior Iranian official strategically leaked the potential of Turkey or Pakistan hosting talks to a major Western outlet like Reuters, that is not an accident.
It's a highly calibrated trial balloon.
Yeah.
It signals to the West, hey, we are publicly rejecting you, but the logistical framework for a secondary conversation is currently being assembled.
Yeah.
And the algorithms and the institutional desks are choosing to trade on the logistical signal rather than the public rhetoric.
I still view this market reaction, bidding up equities and dumping oil based on a leaked logistical framework as incredibly fragile.
It is.
It feels like a driver who has been hydroplaning on black ice for a mile, and the moment the tires catch a single foot of dry asphalt, they just hit the accelerator.
Ignoring the eyes ahead.
Completely ignoring the fact that the road ahead is still frozen solid. If this Pakistan back channel collapses tomorrow, that 4% discount in oil evaporates instantly.
And if the back channel collapses, we move from a localized geopolitical headache into a systemic global crisis. Which brings us to the most sobering data point in the entire Reuters report today, the explicit warning from BlackRock CEO Larry Fink.
Yeah, when the CEO of the world's largest asset manager, a firm controlling trillions in capital, publicly models an apocalyptic scenario, you have to pay attention.
You do.
Fink explicitly warned today that if Iran remains an active threat to that supply chain, oil could rapidly breach $150 a barrel.
A huge number.
And he didn't just stop at the commodity price. He stated that $150 oil would be the direct catalyst for a global recession.
For a sophisticated investor, this really requires moving beyond just the headline and understanding the precise mechanical transmission mechanism of how a localized commodity shock guarantees a global recession.
Right.
It is a sequence of dominoes that falls with almost mathematical certainty.
Let's trace that sequence. Because $150 oil isn't just, pain at the gas pump. It is a fundamental restructuring of the global corporate balance sheet.
Correct. Oil is the baseline input cost for the modern industrial economy. If Brent crude hits $150, the immediate victim is corporate operating leverage.
Okay.
Let's look at the transportation sector, logistics, manufacturing, raw materials. Their cost of goods sold, their COGS, explodes overnight. Now, corporate management teams face an impossible binary choice,
Right, option A. They absorb the rising energy costs internally.
which violently compresses their profit margins, destroys their forward earnings per share guidance, and triggers a massive institutional sell-off of their equity.
It's a bloodbath. And option B, which is what we saw during the post-pandemic inflationary spike, they pass the cost entirely onto the end consumer.
But here is the critical difference between the post-pandemic environment and today.
What's that?
Consumer elasticity is tacked out.
Yeah.
If diesel prices double, the cost of transporting groceries doubles. If a consumer is suddenly spending an extra $300 a month just to commute to work and feed their family, their discretionary spending dropped to absolute zero.
Right, they cancel the vacation, they delay the iPhone upgrade, they stop eating out.
Exactly. And since consumer spending drives approximately 70% of U.S. GDP, the moment discretionary spending freezes, corporate revenues collapse, layoffs begin, and the global recession Fink is warning about becomes a mathematical reality.
And this looming threat of $150 oil ties directly into a massive kind of under-the-radar shift in monetary policy that we saw today.
The Fed pivot.
Yeah, I want to call this the silent shock of the session. Look at the CME Group's FedWatch tool, which tracks the futures market's probability of Federal Reserve interest rate moves.
What's it say?
As of this morning, the market is pricing in exactly 0 interest rate cuts for the remainder of the year.
Let the gravity of that sink in. 0 cuts.
Just a few weeks ago, before this escalation in the Gulf, the consensus was 2, perhaps even 3 rate cuts.
I know.
The market was eagerly anticipating the Fed pivot, the promise of cheaper capital. Now, that expectation has been completely eradicated. The central bank is entirely paralyzed by the threat of an oil-driven inflation shock.
If we connect this to the bigger picture, this represents a structural earthquake in the equity markets.
Yeah.
For the past 18 months, the entire multiple expansion narrative—
The reason stocks kept going up.
Right. The reason investors were willing to pay higher price-to-earnings ratios for stocks was the core belief that the cost of capital was coming down. Lower interest rates mean cheaper corporate debt, which fuels expansion, stock buybacks, and M&A activity.
Yeah.
It also makes equities far more attractive relative to the risk-free rate of Treasury bonds.
But the Fed is completely trapped. If Jerome Powell cuts rates now, while global supply chains are choking and oil is threatening to spike to $150, he risks reigniting a 1970s-style inflationary firestorm.
Absolutely.
He risks permanently unanchoring inflation expectations.
And conversely, if he keeps rates high, which the FedWatch tool now guarantees, he applies a suffocating pressure to an economy where the consumer is already buckling under the weight of rising energy costs.
It's a lose-lose.
It is the textbook definition of stagflation. Stagnant economic growth paired with high, sticky inflation. It is an environment where traditional 60-40 portfolios just get decimated.
So what does this all mean? Let's aggregate the macro environment we've just diagnosed here. We are facing a high probability of 0 rate cuts. The cost of capital will remain punitive.
Yes.
We have Larry Fink telegraphing a $150 oil shock and a subsequent global recession. And our only defense against that energy shock is an unconfirmed, highly fragile diplomatic back channel mediated by Pakistan.
It's bleak. Based on every traditional law of macroeconomic gravity, the indices should be violently bleeding today. We should be witnessing a massive flight to safety. Capital flowing out of equities and pouring into gold, short-term treasuries, and defensive staples.
Yet the Nasdaq is up nearly 1.5%.
Right.
The market is entirely shrugging off the stagflation threat. Why? Because the sheer unadulterated velocity of technological innovation is overriding the macroeconomic decay.
It's incredible.
And that brings us to the second immensely powerful axis of our deep dive, the massive opportunities linked to new technologies.
This is where the true bifurcation of the market really reveals itself. While the macro foundation is cracking, the micro-level execution within the technology sector is presenting institutional capital with growth projections that are simply too massive to ignore.
Regardless of what the Federal Reserve does.
Exactly.
So let's zero in on the Nasdaq's explosive session. The absolute vanguard of the tech rally today is ARM. The U.S. listed shares of ARM Holdings absolutely went parabolic. They rocketed up 15% in a single trading session.
To put that into perspective for the listener, a 15% single-day move for a semiconductor architecture company of Arm's magnitude that is not a retail-driven meme rally.
No, not at all.
That is a tectonic institutional repricing of the company's terminal value and future cash flow generation.
And the catalyst for this massive repricing was Arm's official unveiling of a next-generation AI data center chip. And the internal projections attached to this hardware are just jaw-dropping. They are forecasting that this specific chip design will generate billions of dollars in highly recurring, high-margin revenue.
And this announcement fundamentally shifts how the broader market is conceptualizing the artificial intelligence boom. We've spent the last 2 years obsessing over AI as a software phenomenon.
Chatbots, large language models.
Exactly, generative text, code copilots. But what Arm's 15% surge confirms is that the market now fully recognizes AI as a massive, multi-year physical infrastructure build-out.
I was actually trying to find a mechanical metaphor to explain Arm's unique dominance in this infrastructure build-out.
Let's hear.
We've all heard the cliche about the 1849 gold rush, right? Don't mine for gold, sell the picks and shovels.
Classic.
For the last year, the market has viewed companies like NVIDIA and AMD as the pick and shovel sellers of the AI revolution. But ARM operates on an even deeper foundational layer.
How so?
Because ARM doesn't actually manufacture the silicon chips, they design the base-level instruction set, the fundamental architectural blueprint that allows the processors to communicate.
Right.
So, in the context of the gold rush, ARM isn't selling the shovels. ARM holds the exclusive patent on the specific alloy of metal required to forge the shovel.
Well, that's good.
Yeah. Whether NVIDIA, Apple, or Google designs the final chip, they essentially have to pay a toll to ARM for that foundational architecture.
That is an exceptionally accurate breakdown of their licensing and royalty model.
Right.
They are the base layer of the compute ecosystem.
Yeah.
As hyperscalers, Microsoft, Amazon, Google, Meta, commit to spending hundreds of billions of dollars in capital expenditure and CapEx to build these power-hungry AI data centers, ARM is perfectly positioned to extract a toll on almost every major silicon deployment.
It's a money printer.
It really is.
Yeah.
But as an investor, you must look beyond ARM's isolated 15% gain. The real story today is the sector-wide contagion this announcement triggered.
The ripple effect was immediate and aggressive. According to Reuters, Intel and Marvell Technologies surged nearly 5% each.
Wow.
NVIDIA, which already possesses a staggering market cap, climbed another 2.5%. And the Philadelphia SE Semiconductor Index, the SOX, which acts as the barometer for the entire global chip industry, rose 1.3%.
Because ARM's projection of billions in new revenue acts as a proxy for the entire industry's health.
It's a green light.
Yes, it validates the thesis that hyperscaler CapEx is not slowing down. If ARM is projecting massive deployment of new data center chips, it means the physical build-out is accelerating.
Right.
It means TSMC will get more fabrication orders, Marvell will get more networking orders, and the entire semiconductor supply chain remains in a supercycle. Institutional capital is realizing that the AI infrastructure build-out might be the only sector capable of delivering double-digit earnings growth in a stagflationary zero-rate cut environment.
It's an incredible phenomenon. Capital is just flooding into the semiconductor space as a defensive growth maneuver against macro decay. But AI infrastructure isn't the only frontier defying the macroeconomic gloom today. We also saw a massive influx of capital into a sector that honestly, just a few years ago, was purely the domain of science fiction and government agencies.
The commercialization of space.
Yes.
The velocity at which the space economy has transitioned from government prestige projects to a highly investable, high-beta commercial sector is staggering.
And the absolute center of gravity for this sector today is SpaceX. The Reuters report specifically highlights rampant rumors hitting the trading desks this morning that SpaceX could file its initial public offering prospectus as early as this week.
Huge news.
Yeah, but now, as a sophisticated investor, you know that SpaceX is currently a private entity. There is no ticker symbol SPCX that you can buy on the open market.
Which creates a massive structural bottleneck for capital. You have institutional and retail investors desperate for exposure to Elon Musk's premier aerospace venture, but they are entirely locked out of the primary market.
So capital operates like water. It finds a back door.
Always does.
And today, we saw a spectacular, almost violent example of how aggressive that proxy demand can be. The Destiny Tech 100 Fund, ticker DXYZ, is a closed-end fund that holds a portfolio of pre-IPO private tech companies. Today, that fund exploded by 19% in a single session.
19%.
Why? Because SpaceX is the largest single equity holding within that fund's portfolio.
This raises an important question about the mechanics of premium pricing and liquidity. When an asset like SpaceX is gated and a credible rumor of an impending IPO drops, the market abandons traditional valuation metrics.
They throw the fundamentals out the window.
Exactly. Investors were bidding up Destiny Tech 100 by 19% today, not because they performed some deep discounted cash flow analysis on the fund's other private holdings like Stripe or Plaid.
Right, no one cares about Plaid today.
No. They bought it because they are willing to pay an exorbitant, mathematically irrational premium over the fund's net asset value simply to gain proximity to the SpaceX liquidity event. They are front-running the IPO.
And just like the semiconductor contagion we saw with ARM, the SpaceX IPO rumor acted as a massive demand shock for the entire publicly traded aerospace sector.
A rising tide.
Exactly. The rising tide lifted all the orbital boats. Rocket Lab, which provides highly frequent small payload orbital launches, shot up 6.6%. Intuitive Machines, the lunar logistics company, jumped 9.2%. EchoStar, dealing in satellite communications networks, rose 8.1%.
What you are witnessing on the tape today is the definitive legitimization of the space economy. We are no longer talking about exploratory missions. We are talking about orbital logistics, satellite broadband infrastructure, and commercial payload delivery.
It's real business now.
It is an industrial supply chain that just happens to operate in low Earth orbit.
I love that framing.
And when the undisputed behemoth of the sector, SpaceX, signals that it is ready to open its books and enter the public markets, it immediately validates the entire total addressable market for the smaller players. Institutional capital looks at Rocket Lab and Intuitive Machines and suddenly views them not as speculative venture bets, but as integral components of a mature, hyper-growth industry.
It creates this fascinating dual reality. You have a technological utopia being aggressively priced into the NASDAQ, fueled by the physical build-out of AI data centers and orbital launch cadence, while completely ignoring the fact that the Federal Reserve has explicitly revoked the era of cheap capital.
Which brings us perfectly to the critical third axis of our analysis today.
Let's do it.
We have mapped out the macro terrors, and we have explored the technological supercycles. Now, we must utilize the Reuters data to look under the hood of the market.
Look at the micro indicators.
Yes, market breadth, regulatory shifts, and corporate sentiment. We need these to determine if this rally is actually structurally sound or if it is merely an illusion created by a few massive megacaps.
Let's start with consumer discretionary equities, because there is an elegant, direct mathematical connection here to the geopolitical risks we discussed in Part 1.
Okay, tie it together.
The Reuters report notes that the S&P 500 Consumer Discretionary Index outperformed today, rising 2%, and this gain was heavily driven by a massive surge in the cruise line operators.
Cruise lines.
Yeah, Norwegian Cruise Line gained an impressive 4.3%. Carnival Corp and Royal Caribbean both rose 2.5%.
I look at that 4.3% jump in Norwegian, and my immediate thought goes straight to the algorithms.
Really?
This isn't about a sudden surge in consumer demand for Caribbean vacations. This is a pure mechanical margin recalculation.
Walk me through your thesis there. Because a retail investor might see cruise lines jumping and assume, oh, the consumer is strong, despite the inflation warnings.
It is entirely about the input costs.
Yeah.
Remember the 4% drop in Brent crude we saw at the opening bell, triggered by the Pakistan-Iran back-channel rumors?
Yeah.
Well, what is the single most volatile, massive operating expense for a corporation that navigates floating cities across the oceans?
Fuel.
It's bunker fuel.
Yeah,
It's diesel.
Right.
The cruise lines operate on a deeply delayed revenue model. They sold the tickets for this quarter's sailings 6 to 9 months ago. Their top-line revenue is entirely locked in,
Oh, that makes sense.
but their operating costs fluctuate daily based on the commodities market. When global oil prices plummet 4% in an hour, the quantitative models instantly update the projected profit margins for Norwegian and Carnival.
Wow.
The cost to service those pre-sold tickets just drops significantly, meaning the free cash flow for the quarter instantly expands. The 4.3% rally in Norwegian is a direct, algorithmic translation of the geopolitical sigh of relief in the Gulf. It is an energy trade wearing a consumer discretionary mask.
That is a phenomenal breakdown of how macro geopolitical headlines instantly rewrite micro corporate valuations. But let's shift geographies for a second because we saw another massive valuation rewrite today in global tech, specifically regarding Chinese equities.
Right. According to the Reuters data, U.S.-listed shares of Chinese e-commerce giants, JD.com and Alibaba, both gained over 3% today.
And the fundamental catalyst for this rally is something that should deeply interest any institutional investor monitoring regulatory environments and capital flows.
Yeah, the catalyst wasn't an earnings beat. It was a headline that Chinese state media and regulatory bodies publicly urged the domestic food delivery and e-commerce sectors to end what they explicitly termed a destructive price war.
To understand the magnitude of this 3% jump, you really have to look at the historical context here.
Give us the background.
For the better part of 3 years, the defining characteristic of the Chinese tech sector has been punitive regulatory crackdowns. Beijing actively stepped in to dismantle monopolistic practices, fine tech giants, and heavily restrict their profitability and growth.
Right. It crushed the stocks.
It made companies like Alibaba effectively uninvestable for many Western institutional portfolios. But this intervention feels fundamentally different. By telling JD and Alibaba to stop engaging in a race-to-the-bottom price war, the state regulator isn't restricting their profitability, they are actively establishing a margin floor.
Exactly. A destructive price war is a mechanism for acquiring market share at the expense of shareholder returns. Companies bleed cash to starve out their competitors. When the regulator steps in and essentially mandates a ceasefire, they are signaling a massive pivot in state policy.
They want them to make money again.
Yes, they are telling the market the era of punitive crackdowns is pausing. We now require our domestic tech champions to be healthy, stable, and highly profitable.
That's a big shift.
For global capital allocators, this signals a regulatory thaw. The risk premium associated with Chinese tech drops, and capital tentatively flows back into Alibaba and JD.com, resulting in that solid 3% expansion.
I love seeing regulators artificially stabilize margins, but if you really want to gauge authentic, organic corporate confidence, you look at capital allocation for management.
Absolutely. Put your money where your mouth is.
Exactly, and we saw a highly aggressive move today from Robinhood markets. Robinhood stock surged 6.6% on the announcement that their board has authorized a massive $1.5 billion share buyback program.
A $1.5 billion buyback from a retail brokerage platform in the current macroeconomic environment is an incredibly bold signaling mechanism.
Let me play devil's advocate here for a second, though.
Go for it.
Because when I see a $1.5 billion buyback, my immediate thought isn't always, wow, what a confident management team. Often, my thought is, this management team has run out of organic growth ideas.
Ah, right.
If Robinhood had a revolutionary new product to build or a massive new market to conquer, wouldn't they deploy that $1.5 billion in CapEx or R&D? Isn't buying back your own stock an admission of a maturing, perhaps stagnating growth runway?
That is the classic counter-argument to buybacks, and honestly, in a zero-interest rate environment, you would be absolutely correct.
Okay.
If money is free, you should be aggressively expanding, but context is everything here. Remember the CME FedWatch tool?
The zero rate cuts.
The market just priced in zero rate cuts. The cost of capital is staying painfully high. In a high cost of capital environment, the hurdle rate for new internal projects is massive.
Ah, so the math changes.
The guaranteed return of buying your own undervalued equity suddenly looks much more attractive than rolling the dice on a speculative new product launch.
Because the risk is too high.
Precisely. By retiring $1.5 billion worth of shares, Robinhood mathematically increases the earnings per share for every remaining shareholder without having to actually increase their top-line revenue.
Right.
But more importantly, it is an aggressive defensive posture. Management is looking at the geopolitical chaos, the threat of $150 oil, and the hawkish Federal Reserve, and they are telling the market, our balance sheet is a fortress. We are generating massive free cash flow despite the macro headwinds, and we fundamentally believe Wall Street is severely mispricing our equity.
And that squeezes the shorts.
Yes, that level of aggressive capital deployment forces short sellers to cover and draws institutional value investors into the stock, driving that 6.6% surge.
Okay, so we've mapped out margin-expanding cruise lines, a regulatory thaw in China, and a fortress balance sheet buyback from Robinhood. On the surface, the micro indicators look incredibly robust, but here's where it gets really interesting.
I know where you're going with this.
I want to strip away the top-line index numbers and run a polygraph on the underlying health of this rally. Let's examine the market breadth.
Breadth is the absolute lie detector of the equities market. You simply cannot hide structural weakness from the advanced decline lines.
At first glance, the polygraph looks clean. The Russell 2000, which tracks small-cap companies and is usually highly sensitive to interest rates, is up 1.5% today, hitting a two-week high.
Good sign.
Yeah, that suggests the rally is broadening out beyond just the megacaps. And if you look at the advanced decline ratio, the raw number of stocks going up versus the number going down, the bulls are dominating.
What were the numbers?
On the New York Stock Exchange, advancing stocks crushed decliners by a massive ratio of 6.5 to 1. On the NASDAQ, it was 5.17 to 1.
If you stop your analysis right there, you conclude that this is a structurally perfect, broad-based rally. Massive participation across all market capitalizations.
But the Reuters data contains one final, deeply buried metric that exposes a terrifying structural illusion.
Then just hear it.
Let's look at the ratio of new 52-week highs versus new 52-week lows. On the S&P 500 today, there were 8 stocks hitting brand new 52-week highs and only 1 stock hitting a new low.
Very healthy ratio, perfectly aligned with the 1.16% index gain. That makes mathematical sense.
Now let's look at the NASDAQ composite. The NASDAQ was the absolute star of the session today. It gained an explosive 1.47%. It added over 319 points.
Right, ARM and SpaceX carrying the torch.
Exactly. It is the index celebrating ARM's AI revolution and the SpaceX space economy proxy trades. Yet underneath the surface of that massive 1.47% gain, the NASDAQ recorded 29 new 52-week highs and a staggering 39 new 52-week lows.
Let me repeat that data point because it is the most critical metric we will discuss today.
It's insane.
On a day when the tech-heavy index surged nearly 1.5%, there were more individual tech stocks collapsing to absolute 52-week rock bottoms than there were stocks breaking out to new highs.
How does that architectural illusion even exist? How does an entire index propel itself violently upward while the foundational majority of its constituent parts are actively bleeding out and hitting annual lows?
This divergence is the textbook definition of the distortion caused by capitalization-weighted indices. It is the architectural illusion of a skyscraper.
A skyscraper?
Think about it. If you look at the NASDAQ from the outside, the penthouse is gleaming. ARM, NVIDIA, Microsoft, Amazon, these mega-cap titans are attracting such a massive, disproportionate concentration of global capital that their individual market caps are physically dragging the numerical value of the entire index higher.
But underneath the penthouse?
Underneath the penthouse, the foundational pillars of the building are actively crumbling.
You are talking about the mid-caps, the unprofitable software-as-a-service companies, the highly leveraged tech firms.
Yes, the median tech stock. Why are 39 of them hitting 52-week lows today?
The silent shock.
Because of the silent shock we discussed earlier, the Fed just revoked their access to cheap capital. These smaller, unprofitable tech companies survive on debt issuance and secondary equity offerings.
Right.
In a world with zero rate cuts and a rising cost of capital, their runway evaporates. Institutional investors are violently dumping these vulnerable companies and hiding their capital inside the fortress balance sheets of the AI megacaps.
So the 1.47% gain on the NASDAQ isn't a reflection of a healthy technology sector. It is a reflection of a desperate, panicked flight to quality hidden underneath the mathematics of a cap-weighted index.
Precisely. And this data point serves as a massive warning flare for you, the listener. It proves that passively buying the index in this specific macroeconomic environment is incredibly dangerous.
Yeah, you can't just buy QQQ blindly.
Exactly. If you buy a broad QQQ or a NASDAQ ETF today, yes, you are getting exposure to ARM's brilliant AI architecture and the SpaceX halo effect. But you are also blindly allocating your capital into dozens of structurally distressed companies that are being actively choked to death by the Federal Reserve's interest rate policy.
This market actively punishes the passive indexer. It demands surgical, meticulous stock picking. You have to know exactly what you own, you have to understand the operating leverage of the underlying business, and you have to know how that business survives in a stagflationary environment.
The surface of the tape is serene, but the undercurrents are incredibly violent.
Which brings us to the ultimate synthesis of everything we've decoded today. We began this deep dive by comparing the market to a vehicle with failing diagnostics but accelerating speed.
The 120-mile-an-hour broken car.
Yeah. And the Reuters data has perfectly mapped out both the engine failure and the forward momentum. We are observing a market that is aggressively pricing in a tangible, physical, technological
Yeah,
utopia.
about a doubt.
We see billions of dollars in capex flowing into ARM's new AI data center chips, confirming a multi-year infrastructure supercycle. We see proxy funds exploding by 19% purely on the rumor of a SpaceX IPO, signaling the mature commercialization of the space economy.
But simultaneously, that technological utopia is resting on a violently unstable macroeconomic fault line. We are relying on highly fragile, unconfirmed back-channel diplomacy through Pakistan to prevent a catastrophic energy shock.
It's hanging by a thread.
We are staring down the mathematical reality of Larry Fink's $150 a barrel oil warning, which would obliterate consumer discretionary spending and trigger a global recession. And we are navigating all of this under the suffocating reality of a Federal Reserve that has completely abandoned its rate cut narrative, leaving the cost of capital at punitive highs and driving dozens of mid-cap tech stocks to 52-week lows.
So what for you the sophisticated capital allocator? It is the recognition that these two forces, macroeconomic risk and technological opportunity, are completely decoupled. They are no longer synchronized.
Not at all.
The AI supercycle is attempting to pull the indices into a frictionless future, while inflation, geopolitical war, and the Fed's stagflation trap are desperately trying to drag valuations back down to historical norms.
And as the terrifying divergence in the NASDAQ breadth proves, relying on top-line index data to gauge the health of this tug-of-war is just an illusion. You must separate the structural winners dominating the new economy from the vulnerable entities quietly collapsing beneath the surface.
It is a phenomenal, historic time to be analyzing the tape. And it leaves me with a final, provocative thought for you to dissect and mull over long after this deep dive concludes.
I love these.
Consider the sheer, overwhelming psychological power of the technology narrative today. If a single hardware announcement from an AI chip designer, combined with a whispered rumor about a rocket company's public offering, possesses enough gravitational pull to completely erase Wall Street's panic over losing 2 Federal Reserve rate cuts and staring down a global oil-driven recession, have we fundamentally entered a new paradigm? Have we reached an era where the sheer velocity of technological scale permanently matters more than the traditional laws of macroeconomic gravity?
It is the defining question of this decade. Does the mathematical promise of the infrastructure we are building for tomorrow truly outweigh the structural geopolitical fractures of today? If you look strictly at the capital flows on today's tape, the market seems to believe that it does.
It's an architecture of illusion worth questioning the next time you look at a sea of green numbers on your terminal and assume the underlying foundation is secure. I want to warmly thank you for joining us on this deep dive. Keep heavily questioning the consensus headlines, actively look for the divergences hidden in the breadth data, and remember, when the macroeconomic diagnostics contradict the forward momentum, you have to look past the index and analyze the individual components. We will catch you on the next deep dive.